Hello,
Hi,
it's Mark
Mark.
Mahaney.
Hi, nice to meet you. How are you?
Nice to meet you as well. Hold on one second. Let me close the door.
Sure.
My wife is very happy. My wife is half Korean, so she's very happy to hear about
Oh,
this.
oh, really? Wow. How did you meet her?
We met through a mutual friend.
Oh,
So that's how we met.
yeah. So, you are the one of the who chose the challenging wife, like myself. Okay, Mark, thank you so much for accepting my invitation. It means a lot to me and also for my audience.
Happy to do it. Thank you for including me.
No, no worries. I read your book already, and I believe this book is not actually new, right? You published in US a while ago.
I published it in in 22
In
in
22.
2022.
I see. Okay. Yeah, it's around 2 years old, but still it's very valid. Only one thing I wish to include in this book was about AI, because at the moment, so many investors are interested in AI. But I'm sure we can cover a little bit about it today at the end of the session.
Well, what I found interesting is, when I published the book, I wrote the book, and then it took a long time to go through the publishing process. And so it literally came out in the end of 22, November of 22, which was pretty much when the market just began a major correction. Is that
Ah,
right?
yeah, that's right. That's right.
And and so, like part of me for a while was thinking, well, I wrote a book about tech stocks just at their peak. But then the truth is, one of the big concepts I had in my book had to do with DHQs, these dislocated high quality companies.
Uh-huh.
And my point was, you never know, but all great companies, high quality companies, get dislocated from time to time. And it turned out that's exactly what happened. Now, so you could have, like I applied the same lessons in my book. Like I saw Meta correct materially, and Google and Amazon and Netflix, like a lot of the companies I described as high quality companies, Uber, they all had these massive corrections in 22. And then they came out, like that created the opportunity to, I knew what the high quality assets were. And then I saw the dislocation. So it created all these great DHQ opportunities. I just did a preview when I did my preview for 2024.
Uh-huh.
There weren't any great DHQs because we had this great rally in stocks last year. But like I didn't realize just how useful the lessons would be just to even me. I mean, it was just kind of a reminder that yeah, there are these stocks get dislocated from time to time, and tech as a whole, got wildly um, overbought, aggressively bought in
Uh-huh.
2021,
Uh-huh.
aggressively sold in 2022,
Hmm.
and that created the opportunity in 23, and we had a massive year. And quite, I don't have too many DHQs left, but I do have two that I talk about,
Hmm.
and maybe three now with the recent pullback in Google. So
Google as well. Okay, that's great.
I think the basic thesis is you identify. I mean, I think when we're investing, we're trying to minimize two risks. The valuation risk and fundamentals risk.
Mm.
And the way to kind of, you can never eliminate them, but one of the ways to try to mitigate down or minimize the fundamental risk is buy high quality companies. Companies with great management teams that have addressing large market opportunities, have a track record of really good innovation. I mean, past performance does give you a bit of help in terms of future performance when it comes to management teams. And
Mm.
so at least you hedge down the fundamental risk by really focusing on the high quality names, and then you hedge down the valuation risk by kind of waiting for these moments of dislocation. And they always come up. I don't know if it's every 3 years, 2 years, 5 years. I don't know what it is, but I can tell you that they always come up. You always get a chance to buy. Almost always will get a chance to buy a high quality asset. Like maybe Apple is a high quality asset. It probably is. I don't cover it,
Mm.
but it's had a pretty significant pullback. And my guess is that it's with all the management talent and the technology challenge, and Tesla too. The major pullbacks we've had in the stocks, they probably do set up well for DHQ opportunities.
Mm. Great, great. Okay, so if you are ready, we can officially start the
Oh, okay,
recording. Yeah.
okay.
First of all, even though we have a limited time, we would like to get to know more about you. Please, can you kindly introduce yourself to the audience?
Well, I work at Evercore ISI. I've been working on Wall Street for 26 years now, covering just the internet sector at a couple of different banks: Citibank, Morgan Stanley, Royal Bank of Canada, and now Evercore. And just been covering internet stocks the entire time. I'm based with my family out in the San Francisco Bay Area, and I feel lucky and privileged to be able to cover the sector. It's been fascinating to follow. And it's also something that I and my family use all the time, whether I'm ordering products, whether we're ordering products on Amazon or watching YouTube or staying connected with friends and family using Meta or watching Netflix or using Uber to get to the airport. It's fun for me to cover a sector that I personally have a very strong attachment to. Or my sons and my daughters, my wife and I have 10 children, and they are oftentimes our experts when it comes to understanding social media trends and fashion trends. So anyway, I'm super excited to be talking with you, and I feel fortunate and blessed actually to be covering the internet sector.
Great. Thank you so much for self-introduction. First of all, I would like to talk about your new book just published in Korea. In Korean language, the title says 기술주 투자 절대 원칙. In English, it means the absolute rules for investing in tech stocks. I personally love this book, and it was giving a lot of practical advice and tips for the investors.
Well, here's the rule for investing in tech and growth stocks. And I don't think there's one rule. There's probably several important rules. I do think that stocks generally follow fundamentals. The stocks that have become bigger over time in terms of stock prices and market cap have generally been the companies that have gotten bigger in terms of revenue bases, in terms of profits. I mean, there is a link between fundamentals and stock prices. I know they can be disjointed, they can be dislocated near term, but over the long term, I'm trying to think of a company that's had a materially, substantially bigger market cap and it's had weaker fundamentals consistently over time, and I can't think of an example of a company like that. So anyway, that, to me, is one is fundamentals do lead stock prices, and I feel pretty strongly about that. I've always considered myself a fundamentals analyst. And then secondly, what we're trying to do when we invest is we're trying to mitigate two risks or hedge two risks. This is where the 20% rule comes in. So we're trying to, if you will, mitigate or hedge fundamentals risk and mitigate or hedge valuation risk. You mitigate fundamentals risk, the possibility that revenue growth dramatically slows or margins correct materially. You mitigate that by investing in really high quality companies and high quality management teams. Doesn't mean they can't make mistakes, doesn't mean they can't have bumps in the road, but the better the management team, the better the asset, as measured as by things like the total addressable market, the level of product innovation, how strong the value proposition is to customers, those kind of things that I talk about in the book. Like if you focus on the highest quality companies, you're going to mitigate or hedge down some of that fundamentals risk that I worry about. The other part that investors and I have to worry about is, what about the valuation risk? And the valuation risk is, you may find a really great asset, but how do you know you're buying it at the right price point, at the right valuation level? And oftentimes that's hard to know. I mean, valuations can be set by the companies internally. The faster they grow their earnings, usually the higher the multiple. But oftentimes the valuation, and always the valuation, is influenced by what's happening in the market overall. So if you have aggressively rising interest rates, that can swamp the impact of aggressively rising earnings. So it just depends. There's a lot of factors in there. So one of the things you can do to try to hedge down, to mitigate that valuation risk, is wait for high quality companies to get dislocated. That's where I came up with the idea of dislocated high quality companies, or what I call DHQs, dislocated high quality companies. There's an old adage on Wall Street that says, buy low, sell high. Well, I prefer to turn that and kind of say, buy high, low. So look for the high quality companies, buy high quality companies, but wait for their prices to become low. How do you know when a price is low? It just as a quick rule of thumb, I look for this 20% correction. You have to use your judgment here. If the stock soars 300% and then corrects 20%, that's maybe not a major correction. But usually a 20% correction gets you a chance. First identify the high quality companies and just wait for those ebbs and flows in the market and in the company's specific companies' stock action. You can wait for those opportunities, and that way you've at least mitigated, never eliminated, but you mitigated some of the fundamental risk and some of the valuation risk. So that's where the kind of the idea of waiting for the 20% corrections came in.
Mm-hmm, mm-hmm. Yeah, when it comes to DHQs, we had quite a lot of stocks back in 2022, but I think these days it's not very easy to find those.
You're right. It isn't easy to find those, but there's still a few in the large cap sector that I look at. I would put Amazon. It's still DHQ. It's high quality, but the stock is still trading well below its average multiple of the last couple of years. And another possible one is Expedia. EXPE is the ticker. Mm-hmm. It's also trading at a very low multiple. It trades at almost 12, 13 times earnings. And then there's a third candidate. There's a stock that's now started to materially underperform the market, and that's Google. And Google hasn't materially underperformed the market in several years. Google, like other big tech companies, like the rest of the Magnificent Seven last year, Google did very well as a stock. But these concerns have come into the name now about whether they can manage their costs well enough. What happens to Google in a generative AI world? Maybe they'll start losing market share. So these concerns have kind of come up and have caused the stock to kind of materially underperform. So the setup on Google right here, right now, is that the stock is off, 4 or 5% on the year, whereas the market is up, whatever it is, 8% on the year, 8 to 9%, the S&P 500 and Nasdaq. So it's only pulled in 15%, so it hasn't hit my 20% rule yet. But I'm intrigued. I mean, Google, I would absolutely consider high quality, and this is like we're getting close to DHQ land for Google, in my opinion, which hasn't been the case in over 2 years. And so it's just, to me, I identify the high quality companies, wait for them to get dislocated because they all get dislocated.
I see. I mean, looking at the stock market history, there were quite a few companies who had a glorious period, like IBM or Intel, but those companies never came back from dislocation. So, in your opinion, the Google has a chance to come back, even though they're having very difficult time at the moment in terms of search business and also to catch up the Microsoft in terms of AI. What is your opinion for that?
Yeah, I think they do. Now, I can give you better examples than what you just mentioned. I think about Netflix and Facebook. Both of those companies had 75% stock price corrections in the last 2 years. 75%. And now those stocks Facebook is back up above that level and is actually at an all-time high. And Netflix is getting back on track to being at an all-time high. So you can find cases of high-quality companies that get dramatically dislocated. Now, when that happens, and as you mentioned, IBM in the past and Intel, there are times when companies are going to have to make major pivots. I think Meta did that, and I think Netflix did that. Netflix did it by introducing their advertising supported service. And that was a major pivot. They never were willing to consider it. Then they had a major dislocation and they realized we need to make a change. And they made the change. Meta, the same thing happened. They realized they needed to get much more aggressive with their cost structure. And they realized they needed to rebuild what I call their ad tech stack using AI. And I think they successfully did that. That's why the stock went from, where are we now with Meta? The stock went from about $400, I believe, down to $90.
Yes.
And now it's back up at 500. I mean, that you rarely see that. But when you see that, if you have 75% correction, now that's true dislocation. And it usually means that it's more than just a near-term issue. It usually means that the market is really worried about a structural change. And that actually was true with both Netflix and Meta. But the companies, to their credit, realized they needed to make a major change, and they did.
Yes, I believe there was a very valid point. You just mentioned pivot point in terms of like company performance. It was a very good example for Netflix getting into the ad business. And also when it comes to Meta, they call it like the year of efficiency, right? So they focused on the cost management and did a great job. If that is the case, Google need to do the same thing, right? They have to make a big turning point. What would be that pivot? Would it be like a replacing CEO, or well, what kind of actions would you expect from Google?
Possibly. They possibly do need to change the CEO level. There's an enormous amount of talent and inherent advantages that Google has as a company and investors have in holding Google as a stock. It has a core business that generates an enormous amount of free cash flow. They have over 100 billion on the balance sheet. They've got this wonderful search business and YouTube business. They're levered to the digital games market. They own. They have these assets like Gmail, Android, Google Maps that each have well over 1 billion users. Like, the amount of data that Google has is just stunning. They may have more data. They probably do. They probably have more information about consumers than any other company in the world. And that should give them a huge advantage. They do need to do 2 or 3 things now, though. I think they need to get a lot more aggressive with their cost structure. Mm-hmm. They need to also kind of focus more aggressively on products. I think they've allowed politics to get too involved in the managing of the business. They need to focus just on shipping really great product. And and then just need to make sure, like, I think they probably are at the cutting edge of Gen AI. And what I've seen in Gemini has been very impressive. I think they need to start increasing the ship speed, getting their Gemini products deeper out there, into Google Docs, into Gmail, into Google Worksheets, Google Spreadsheets. And I think if they do that, I think the sentiment on the stock can change pretty materially over a 12-month time frame.
Right. Good news for the Google shareholders. By the way, you just mentioned quite a few stock names. Out of 7 stocks called Magnificent 7, which stock would you say it's your top pick? Is there any one specific name you really like at the moment?
It would be Amazon.
Uh-huh. What would be the reason?
And the pitch on Amazon is 3 reasons. First, and they're all what I call fundamental inflection reasons. So I think you're going to have an accelerating revenue growth year for AWS, or Amazon Web Services. This is their cloud business. And it's one of the highest margin businesses at the company. And it's the part of the business that really had a dramatic slowdown in its growth rate from 2022 to 2023. Growth rate went from 33% year over year down to 12% year over year. Just a dramatic correction. And I think that was one of the biggest reasons why the stock so underperformed. But now I think that's going to start turning. The stock performance, it's already started to work up in anticipation of this. But I think you're going to start seeing AWS revenue growth accelerate as we go through 24 and into 25. And that's extremely important to the business because it's considered to be one of the highest margin businesses, one of the most important businesses for the future of the company. That's the first fundamental catalyst and the first reason it's my top pick. The second one is I think the core retail business is going to have record high operating margins this year. That's due to a variety of factors. You're seeing a little bit of acceleration in retail growth. It's because they've taken a lot of cost measures, but also because they've taken a lot of productivity measures. They've taken their distribution centers and they've moved them. They made them closer to the consumer. And so this has had a wonderful twofold impact. It's allowed them to reduce their shipping costs. So it's a shorter distance between. They kind of did what Coupang has done in Korea.
Yeah.
Like they brought their distribution centers closer to consumers and dramatically shrunk the amount of time it took to get packages. And So they reduced their cost to serve, their cost to ship, but it also increased consumer demand. There's this basic concept in economics called price elasticity. The lower the price, the more the demand.
Mm-hmm.
I coined a concept called shipping elasticity, which has done very well in Korea with, which is that the faster you ship, the more people demand.
Yeah.
So anyway, that's the second reason that I like Amazon. First is this acceleration that we're going to see in AWS growth. Second is I think the retail business, for a variety of reasons, including productivity gains, is going to get to record high operating margins this year. And the third fundamental reason why I like Amazon now, their top pick, is I think we're going to have a record high free cash flow margins for the company as a whole. And that's in part because the company's been more careful about capital expenditures or CapEx, and in part because the margins of the business are rising. So those are what I call the three fundamental reasons to like Amazon as a stock. And then it is somewhat dislocated, to use the concept in my book. Like the stock is trading, if I look at this carefully, I don't know, 12, 13 times EBITDA. I mean, prior to COVID, this company very consistently traded at 18, 19 times. So I'd argue that it's still dislocated versus its prior multiples. That's not the case with Meta. It's not the case yet with Google, but it's definitely the case with Amazon. So it just tells me that if the fundamentals turn, you could see the multiple go higher. You could see a re-rating in the multiple. That's why it's, I love to see DHQ stocks mean that stocks can go up with strong earnings growth and with a higher multiple. That's what I call like a double-barreled or a twofold way for a stock to rise. It's a very key area if you can get a stock like that. I think that's where Amazon is today.
I'm with you. I agree all of your points, and which are very valid. Only one concern I have at the moment is actually market share of AWS. It used to be around 33, 34. Now I can see that back in Q4, it has gone down to 31%, I believe. So Microsoft is catching up. Would you consider it as a risk?
Yes, it is a risk. It is a risk. One of the reasons that in the past, Amazon was able to sustain a high multiple was that it was considered to be the global leader in the fastest, highest profit part of software, which was cloud computing. And then it looks like it's lost. It still is the market leader, but it looks like it's losing incremental share. And there's a question now about whether it's losing innovation mind share, whether they're less at the leading edge of cloud innovation. That's a very hard thing to know one way or the other. But that's why if we're right that we're going to see this acceleration in revenue growth from AWS this year, that'll probably answer a lot of the questions about market share losses and innovation share losses.
Sure. All right, thank you. So your first pick was Amazon. What about the second pick out of 7? Which one would you go for? Would you go for, you just called Google as a DHQ, or do you have any other stock name looking better than Google?
Well, I like both Meta and Google. It really depends on your time horizon. So, and we've had a big rally in Meta shares. I mean, they're up 44% year to date, and they're within 10% of their recent peak multiple. That's Meta. Google is within 10% of its trough PE multiple. So I like being long both assets. I have preferred Meta for the last year and a half. I feel like it's time to shift that a little bit. I want to be long both assets, but I feel like I want to be a little bit more aggressive with Google now than with Meta. It seems to me like there's more upside here. There's more room for the sentiment to change on Google.
Sure. Regarding Meta, they are starting to pay a dividend. Would you consider as a good news, or is it like they are starting to see themselves as a value stock rather than growth stock? What is your opinion about it?
I think I think Google has more than $100 billion of cash and securities on its balance sheet. It should absolutely be paying a dividend. My guess is that it will. My guess is that there'll be enough pressure on them from shareholders, from the market as a whole. Meta's paying a dividend, and they have 50% as much cash as you do on your balance sheet. Google, it's time to start paying a dividend. My guess is that they will. My guess is that you'll see an announcement, and I would consider that a value catalyst. I think stock would go up on that.
Yeah. Right then, that's all the questions I have for today. Once again, thanks so much for your time sharing with us. Hopefully, in the future, we have another opportunity to invite you to our channel.
I hope so. Thank you very much for reaching out. I very much appreciate it.
Thank you. Have a good day.
You too.
Bye-bye.